Hello and welcome to Week in Markets. Today I'm joined by Kevin Kidney, Head of Investments here at True Potential. So Kevin, I suppose we're 2 weeks out from the autumn budget. We've had several economic data points this week. Is there anything that will lift Rachel Reeves' mood ahead of the budget?
There isn't currently. I think that we can take some indication from Prime Minister's questions this week that certainly the path of interest rates in the Bank of England is lifting the spirits in Downing Street. The Prime Minister referenced the 5 interest rate cuts that have taken place since Labour came to power. All else, I'm afraid, is either as good as it was last year or worse. So the growth picture is probably going to come in as expected, growth above but close to 1%. But apart from that, the underlying trends within the economy are weakening. It's pretty clear from the data we've seen this week.
I suppose, we've had the UK GDP data today and it was negative, I think 0.1, worse than expected. But when you look at the underlying components of that, is there anything that stands out to you?
So the trend in the UK is still quite weak. If we think that the economy at full capacity could generate growth of close to 2%, then we have growth between 1 and 1.5 at the moment. And that's with running a fiscal deficit of somewhere between 4 to 5%. The last 3 months of GDP have seen an economic contraction. Now, much of that can be explained by the cyber attack on Jaguar Land Rover, which saw a complete shutdown of its manufacturing capabilities for the whole month of September. And that has led to a negative month in September. But we also saw a negative revision for GDP in August. And that compounds what was a negative month in July. So we've got very low growth at the moment, very weak impulse. Some of it can be explained by what happened with Jaguar Land Rover, but it does appear that there was a turn some point around the spring and the trend for growth is lower and weaker in the UK.
And I suppose if we also take a look at the employment picture, which we got a read for October earlier this week, was it very much the same?
So this is where if we had a dashboard, we would be changing the bulb flashing from amber to red. It's particularly concerning now in the UK. So we saw another rise in unemployment. We're up at 5% now. The last 12 months, we've moved from 4.3 to 5. More worryingly for Labour, when they took office July, unemployment was 4. It's now 5, so we've seen a full percentage point rise in unemployment. If we just take the last 12 months and look at payrolls data, these are people registered for employment with HMRC, 11 of the last 12 months have seen jobs lost. So in total, we've seen about 180,000 jobs lost over the last 12 months. There is also a clear weakness coming through in private sector pay awards. We have private sector pay awards are declining year on year in terms of growth rate and are now the lowest in 4 years. That's encouraging for inflation because that should actually reduce domestic inflation pressures over the next year or so. Worryingly low and somewhat juxtaposed with the private sector data is that public sector pay growth is accelerating and is now at a 2-year high. So that's quite unsustainable, given that just places extra burden on the public finances. So the underlying trends for unemployment are worrying in that payrolls data is continuing to show weakness, and the survey data, that is where there's a wider survey across the economy, that's now turned, and that seems to indicate that on the survey-based information that full-time employment stopped growing in the spring and has now started to contract. So many of the indicators on the Chancellor's dashboard should be flashing red for employment.
Okay, so the UK economy is really struggling to gather momentum. I suppose one positive is that inflation is a little bit better, and that's coming through in the wage growth numbers. But for Rachel Reeves ahead of the budget, it is a real challenge for her to really stimulate economic growth given the fiscal headwinds.
Yeah, and it's interesting actually say to stimulate growth. It does seem pretty clear there is no intention of stimulating growth within this budget, and that the capacity to do that is limited. Typically, you would expand the investment or the capital budget, and that's been protected but not expanded. Or you would look to stimulate consumption, perhaps by lowering taxes, for example. And we know the opposite is coming. So this does appear to be a very tight budget coming. We can expect some fairly broad-based tax rises, and that's really just to try and build up this so-called headroom, where the Chancellor would like to perhaps have a little bit of cash in the bank in case the economic slowdown accelerates and she has to deal with some more difficult problems in the next year or two.
Okay, and let's just tie it all together to think about what this means for investors, for our portfolios. What does it mean for UK equities and UK bonds?
Well, the great news is that the stock market does not represent a domestic economy. So we're seeing the FTSE 100 near all-time highs, and we're also seeing gilt yields now outperforming, and the yields on government bonds in the UK are continuing to fall. So we're going to see lower interest rates in the UK. The Bank of England are likely to begin cutting rates again in December, and we'll probably do 3 or 4 more rate cuts next year and perhaps take base rate down towards 3%. And the stock market is probably being boosted by some global factors. We're in a global earnings boom. We know we're in a capex boom from global industrials, AI, global utilities. We also know that the banking sector across Europe has recovered entirely from the global financial crisis 15 years ago, and domestic banking sector has returned to supernormal profits. So that's very supportive for corporate tax receipts. Doesn't necessarily mean we'll see it filter into economic growth, but the great news for multi-asset portfolios is they are benefiting from this boom in global profitability.
Thank you, Kevin. And on that positive note, we'll end it there. Thank you all for watching, and we'll see you next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.